Now let's summarize adjusting entries. So adjusting entries are done right before the financial statements are made because we need to update the accounts. Otherwise, the financial statements would be incorrect. Each adjusting entry affects either a revenue or an expense. Therefore, the income statement is affected. Also, each adjusting entry affects either an asset or a liability. Therefore, the balance sheet is affected. So if you forget even one adjusting entry, both the income statement and the balance sheet are going to be incorrect. Also, don't forget that adjusting entries never involve cash. So let's look at the different types of adjusting entries we learned about. First, we learned about prepaid expenses. These are things like prepaid rent, prepaid insurance, office supplies. So when we first purchase these items, we would increase an asset account because these things have a future benefit. And then at the end of the accounting period, we need to update how much of those assets have been used up. For example, for office supplies, we would calculate how much of our office supplies have been used up, and then for the debit account, we would increase an expense called office supplies expense, and then we would lower the office supplies asset account to show how much has been used to update that account so its balance is correct. Next, we learned about accrued expenses, and the most common example are salaries payable. So at the end of the accounting period, you need to calculate how much you owe your employees for salaries, and then you would increase an expense account like salaries expense. And then because the end of the accounting period usually does not fall on a payday, you are not going to pay your employees on that day. Therefore, you owe them these salaries. Therefore, you would need to increase a liability account such as salaries payable. Then we learned about unearned revenue. This is when customers pay the company in advance for a product or a service to be provided in the future. The classic example are magazine subscriptions. A more current example would be a subscription service like Netflix. So when Netflix originally receives money from a customer, the customer is paying for the future month of streaming service. Therefore, Netflix would increase cash, and they would also increase a liability called unearned revenue. And then at the end of the accounting period, they need to do the adjusting entry. So they would need to lower the liability called unearned revenue. And how do you lower a liability? With a debit. And then you would increase the revenue with a credit. And for Netflix, the revenue would probably be called subscription revenue. Then we learned about accrued revenue. This occurs when we've completed work or part of a job but have not yet been paid. Therefore, at the end of the accounting period, we need to show that our customer owes us that amount by increasing the asset called accounts receivable. And because we've earned part of that job, we need to increase the revenue account. And then we learned about the very, very, very common adjusting entry called depreciation. So at the end of the accounting period, we increase depreciation expense with a debit, and then you increase the contra asset account called accumulated depreciation. Now let's look at the impact of adjusting entries on the financial statements. So failing to record adjusting entry results in incorrect financial statements like we said before. For example, if you miss just one single adjusting entry, both your income statement and your balance sheet is going to be incorrect. So here's the different types of adjusting entries. And then on the far right column, here's the impact of forgetting to do the adjusting entry. So the first one, deferred expenses, that's just a fancy way of saying prepaid expenses. These are advanced cash payments of future expenses. The examples are prepaid rent, prepaid insurance, and office supplies. So for the adjusting entry, you would increase an expense with a debit, such as office supplies expense, and then you would decrease the office supply asset with a credit. So if you forget to do that on the income statement, expenses will be understated, which means they're too low, which would mean net income is too high, overstated. And on the balance sheet, assets would be overstated because you forgot to lower the office supply asset account. And because expenses affect equity, if you left out the expense, then the equity would be overstated because remember, expenses lower equity. For deferred revenues, these are advance cash receipts of future revenues, such as magazine subscription. The adjusting entry, as we mentioned before, you debit a liability to lower the liability when you earn the revenue, and then you would increase a revenue account. So if you forgot this adjusting entry on the income statement, revenues would be understated, and therefore net income would be understated. And on your balance sheet, liabilities would be overstated because you did not lower your liability with the debit. For accrued expenses, that's an expense that has been incurred but not yet paid. The classic example for this is wages payable or salaries payable. For the adjusting entry, you would increase wages expense or salaries expense, and then you would also increase wages payable or salaries payable, whichever word they choose to call the account. And so if you forget to do this adjusting entry on the income statement, expenses would be understated and net income would be overstated. And on the balance sheet, liabilities would be understated. For example, if you forget to record that you owe salary at the end of the year, that liability would be missing from the balance sheet. And finally, for accrued revenues, that's a revenue that has been earned, but cash has not yet been collected. So at the end of the accounting period, you need to increase the asset AR to show that your customer owes you that money, and then you would record revenue. So if you forget to do this adjusting entry on your income statement, revenues would be understated, and therefore net income would be understated. And then on the balance sheet, your assets would be understated because that would have meant that you would have left off recording the accounts receivable. And of course, on all of these, anything affecting the income statement would mean that your taxes would be incorrect. So these adjusting entries are very, very important, and that's why accountants who usually do the adjusting entries are usually paid more than bookkeepers, because bookkeepers usually do not do the adjusting entries.